My name is Thomas, and this is For the Common. FTC is all about arming everyday investors with the tools and information they need to be successful. And a part of that is taking a really complex finance topic and breaking it down. Over the last several weeks, there have been so many conversations about the Federal Reserve. But in particular, it's been about how the Fed's out to crash the stock market and that they're out to get the little guy like you and like me with their diabolical interest rate moves. And it's understandable. The stock market over the last several months has been really volatile, and a lot of that has been attributed to the Fed. Just look at the last week. We had the stock market go down Tuesday, Wednesday because of Fed comments to the news or because of Fed meeting minutes. So I get why people are thinking that, but I'm actually here to tell you that the Federal Reserve is your friend. And I know you may not believe me, but they're trying to help. And importantly, they are actually required by law to look after your best interests, though it may not feel like it right now. So I want to go through some slides that talk about the Federal Reserve and also talk about the really difficult balancing act that the Fed has to try and manage. And I'll also give my outlook on the market, and hopefully with my comments, I'll put your mind at ease that the Federal Reserve is not out to eat your lunch. So I'm going to jump into the slides now. So the Federal Reserve is out to tank the market. What gives? Well, as we talked about, there's a lot of fear out there, and the reason why is that money supply really matters. And when I say money supply, I literally mean the number of dollars that are floating out there with respect to the US economy. Sounds pretty complex, probably difficult to control. It definitely is, but governments will try and impact money supply using two main policies. So those policies can be fiscal and monetary policy, and they're very important because they can very much impact market cycles and create some of the good times, but also create some of the bad times. So investors pay very close attention to these two policies, but you got to know the difference between the two of them. And fiscal policy is set by lawmakers. So people who get elected every 4 years, they're the ones who set fiscal policy. And really the way fiscal policy gets executed is through either the government spending or the government taxing. So taxing makes sense. We all deal with that. You tax the 1%, or maybe you tax corporations more, or you give a tax credit for a electric vehicle. Those are all ways that the fiscal policy might impact where dollars are going. And as well, they can borrow and spend. So stimulus checks, anyone? Those were nice. That will directly impact how consumers spend their money, or at least that's the theory. Or they could put money towards infrastructure or healthcare initiatives. That's another way that fiscal policy can direct dollars where lawmakers want it to go. And then monetary policy, that's on the other side of the coin, where the Federal Reserve comes in. And the Federal Reserve was created in 1913 with this goal of trying to manage the economic cycles better. And they, by law, have a dual mandate in what they're trying to accomplish. And number one is they're trying to maximize employment. So have as many people employed as possible. And then the second thing that they're trying to do, and equally important, is stabilize prices or manage inflation. And there's been a lot of talk about that recently in driving Fed decisions. So they have a couple of tools that they can use to really execute monetary policy, but they're complex. So we're going to jump into them now, and we're going to talk a little bit about economics. So bear with me. But fiscal policy is pretty straightforward. If the government taxes you more, they're taking money out of the money supply because it's going to the government. Or if they go out and spend money, that puts money into the money supply. Monetary policy is a little different, so bear with me. But the government can go out through the Federal Reserve, and they can just buy or sell things in the open market. So if the government steps in to buy a bunch of bonds, for example, it's probably going to be a pretty big order, and that means demand is going to go up a lot. Well, if demand goes up, we know that prices go up. And if prices go up on bonds, that actually means that bond yields go down. So the government can step in and buy a bunch of bonds in the open market, and that makes yields go lower. Interesting. And that also puts more money in the money supply because they're going out and buying these bonds from individuals, and that's putting money in those individuals' pockets to go out and hopefully spend. That's really the goal of the Federal Reserve and that monetary policy tool. And then second, the Federal Reserve can just set the interest rate, and they set interest rates through their federal funds rate, and that's the rate that banks charge each other to borrow. It's set by the Federal Reserve. And if banks have to charge each other more, that will cause them to go out and charge more to all of their customers. And the federal funds rate impacts the interest rate for almost any loan out there. So if you think a mortgage, a car loan, maybe if you have a margin account like I do, that all gets impacted by the federal funds rate. And if they increase rates, then I might not go out and buy that fancy car because it's going to cost me a lot more on that loan. Or if the Federal Reserve decides to lower rates, I might want to go out and spend for that bigger house because now I can afford more. And that's how they can impact the money supply and incentivizing people to take on loans with lower rates. And then the last thing, a little bit more complex, is through bank reserve requirements. And that means when a bank takes a deposit, so you give a bank money, they have to set a little bit aside as backup in case something happens, and it's called a reserve. So the Federal Reserve can require banks to have more in backup or reserve more, and that will cause banks then to ultimately lend less. So if they have less money to lend to customers, that's going to cause the money supply to shrink because banks have to hold on to more of the money and consumers have less. So I know some of you might be thinking the very important question of, so does that mean more money equals more problems? Unfortunately, that definitely can be the case, and money supply can very much impact economic growth, market cycles, inflation, and that's the goal of fiscal and monetary policy, to try and regulate the economy and set conditions for good long-term sustainable growth. So think remove that boom and bust cycle, and that's the goal of fiscal and monetary policy. And they usually can take two different stances, and they can be focused on driving growth with expansionary policy or maybe tamping growth with a contractionary policy. So expansionary can sometimes be called easy policy, accommodative, maybe dovish. And how that's done is, say the Federal Reserve, through monetary policy, decides to lower interest rates. Well, like we said, if they lower interest rates, it's more affordable for me to borrow, and I might go out and buy that fancy new car. That would drive growth in the economy, increase in money in the money supply. Or fiscal policy might decide to lower taxes, so I would have more money in my pocket as a consumer, and I might be more willing to go out and spend. Or the Federal Reserve might buy bonds and then lower rates as a result, interest rates, and that would cause borrowing to be more affordable, again, similar to the first. Or the government might go out and spend more money, and if they spend in a big infrastructure project, that puts more money into the economy, and that would be another fiscal policy that's expansionary. But then contractionary or tightening or hawkish, that's literally doing the exact opposite. So the Federal Reserve could increase rates, or the government might decide to raise taxes. Those two would take money out of the money supply and be contractionary. Or the government might sell bonds and cause rates to go higher, or they might reduce their spending. All of those things would reduce money supply and cause growth to ultimately slow. So I want to revisit now the Fed's dual mandate because it's very important, because The fiscal policy, again, is set by whatever political party is in power, but the Fed has a strict responsibility by law, and it's called the dual mandate. And it becomes this really difficult and what I call the great balancing act. So to explain, the Federal Reserve's first priority with their dual mandate is to maximize employment. So if you think about an economy where a lot of people are employed, you probably have really strong economic growth, and companies are probably crushing it, making a lot of money, so they want to invest more and they want to hire more people. And if they're hiring more people, then that means that wages are going to go up because workers are in demand. And that also means that people are likely staying in their jobs longer and are finding better jobs. And that's what the Federal Reserve would consider full employment or maximum employment. So then they have to balance that then with stabilizing prices or keeping inflation under control. And what drives inflation is when there is too much demand for not enough goods to go around. So think about oil right now, or maybe houses where you live, or maybe even stocks. How about bread? All of those could be impacted by having too much demand, but not enough goods to sell to people. And demand is at its highest when the economy is strongest. And another thing is that rising wages for people can really drive inflation, because that means they have more money to spend on the goods that they want to buy. So if you think about that, the Federal Reserve has to balance maximizing employment, which is going to be at its best when the economy is strong, but then also trying to minimize inflation, which will be at its worst when the economy is strong. That's the balancing act. And does it sound familiar? That's actually where our economy in the US is at right now. So the Federal Reserve has made it clear that easy, accommodative monetary policy is going away. So do we panic and do we sell everything that we own? In my opinion, no. But you might be thinking then, less accommodative monetary policy has to be totally bad, right? Again, I don't believe so. I actually think that a less accommodative policy is a signal that the economy is doing well and is actually pretty strong. See, think about when we implemented all of this accommodative policy. It was back when COVID was raging and we were all shut down and trapped in our houses. That wasn't fun. I mean, I'm for one very excited to be saying goodbye to COVID, and that's because the economy is reopening, and as a result, it's actually quite strong. And the Federal Reserve is signaling that by saying, hey, we don't need this accommodative policy anymore. And in my opinion, I think the Fed's actually taking the right steps to try and tamp some of this growth that we have and also reduce the inflation that we've seen. So you might be thinking, has this happened before? And yeah, totally. Happens all the time. Actually happened relatively recently, 2015 to 2019, and we all survived. The economy actually did really well in that period too, and you might remember back to it. There's actually a time that President Donald Trump picked up the phone and called Jay and told him to be even more accommodative despite a really strong economy. And Jay, as the Federal Reserve independent, decided that he wanted to stick to a tighter policy because growth was so good. And that's what he ended up doing. And he kept raising rates. So we have gone through this before, and it was pretty recent. And actually, the economy did good. So why has the market been so meh recently? Well, perception really matters, and investors don't like uncertainty, and we're seeing that reflected in the market today. But we've actually already chopped a lot of wood with respect to perception around where rates are going. But the reason why things have gotten a little bit more challenging in the market is that people are questioning that balancing act of the Fed. And to explain it a little bit more, I want to go to the charts. I love charts. Charts are the best. And if you want to make some really great charts, you can meet my friend named Fred here. Fred is the Federal Reserve Economic Database site, I guess. And it has a lot of really awesome information that the Fed puts together with respect to economic data. So I've searched a lot of different things here, including the federal funds rate, inflation, 30-year mortgage rate. We'll talk about a lot of these. But I want to start with the federal funds rate. And if you click search, you'll come up with a lot of options. And first one is the federal funds effective rate, which is the rate that the Federal Reserve can control and is what you hear about when they're talking about raising rates. So if we go back on this chart to 1954 on data, you can see how the rate over time has fluctuated, started low, and then at one point went to 22% in 1980, which is pretty crazy. I mean, imagine trying to get a mortgage in that time. And some people are worried rates are going to go back there. I personally don't think they will, but we will see. Time will tell. But over time, then rates fell back low again. And you can see since 2008 in the Great Recession, where we had a lot of that accommodative policy for the economy, rates were low for a very long time. But then again, in 2015, like I mentioned, we had a rate hike cycle where rates went from 0 to about 2.5%. And then the economy slowed a bit, and then COVID hit, which was really, obviously, nobody could have predicted that. And that caused rates, in a sense, to try and be accommodative to plummet. And that was the Federal Reserve's attempt to try and help the economy grow. And then if we go back to this view here, you'll see that this little blip right there in the bottom right corner, that is the recent rate hike that we all just went through and has been the reason why we've had so much stock market volatility. So a lot of that volatility just driven by that little blip in the chart. And just again, on that 10-year view, you can see we just had that one step up in a rate hike when the rate hike expectations to come. So if we look at the stock market and using the S&P 500 as an example, this is the S&P 500 ETF known as SPY. That's the ticker, and it's a great proxy for performance. You can look here on Morningstar with me if you want. And over the last rate hike cycle, 2015, 16, 17, the market actually did pretty well. It was up 1%, 12%, then 21%. In 18, we did hit a speed bump. The market was down 4%. You can see kind of rose throughout the year and then tumbled into the end of the year. I remember this very clearly. This was actually because of similarly to what we're going through now. And then the next year in 2019, the stock market was up 31%. That's a really big move and shows that, again, we've lived through one of these tightening cycles before and the market really did pretty okay. So I want to jump to CNBC now and look at interest rates because they're really important. You've probably seen it on the news right here. 10-year yield touches 2.7 first time in 3+ years. A lot of the market volatility that we've seen in stocks over the last several months has been driven by the moves in the bond market. And when I said there was a lot of wood that's been chopped, that's been in the bond market with respect to expectations of what the Fed will do with interest rates. So as I mentioned, the federal funds rate will impact every other fixed income instrument out there as they raise rates. It becomes more expensive to borrow. And you can see that impact directly in the treasury market. And these are U.S. treasuries. And for a proxy of in 1 year, it would cost the government 1.7% to borrow. And you think right now rates are at 0. The Federal Reserve has only they've increased them once, so to 0.25. And so this shows the expectation of what investors think the Federal Reserve will do over a year. So they're expecting there to be a lot more rate hikes for a year and then even more in a 2-year span that would get us back to around the interest rate that we saw back in the last tightening cycle in 2018 and 2019. And then you can see all the way down to the 10-year, 2.7. So an expectation to do a lot of the rate hikes early and then likely not have as many rate hikes in the future as investors expect the economy to slow. And then if we look at this in a bit of a different way, this chart shows the federal funds rate versus that 10-year Treasury, and this is constant maturity, so just how it looks over time. And you can see back in early 2020, the 10-year Treasury was at 0.66%. That was really low. And over time, as expectations for the economy, economic growth improved, and as well the Federal Reserve hinted at raising rates, there's been a massive move in the 10-year recently, and that's gotten it to the level that it is today. Again, demonstrating that a lot of wood has been chopped. And that even translated over to mortgages. So this is a 30-year fixed rate mortgage. You can see this big jump that we've had recently because of the talk of rate hikes. And sorry, my friends, if you're out looking for a mortgage right now, there's a high likelihood that you're going to be paying more for your mortgage than you could have paid about a year ago. And you can see that big jump again because of that little blip in increasing rates. So then if we look at the Federal Reserve's dual mandate, the first thing that they try and accomplish is maximum employment. And this is a great way to view that through the unemployment rate. So you can see here recently, unemployment rate is really low. It's 3.6%. That means a lot of people have jobs. And you can go back in history and see in the last cycle, that was about the maximum employment that we hit. Before that, about 4.5%, and then the late 2000s or early 2000s, was at 4%. So the low for unemployment rate is around that 3 or 4%, and the Federal Reserve would look at that and say, we've achieved goal number one. We have maximum employment where people have jobs and can get jobs. And that's showing that they're probably succeeded on that first, mandate. But then that balancing act, I want to show this where it's the unemployment rate versus the federal funds rate. And you can see that when employment really is doing great, the Federal Reserve with this red line started to increase rates. And that's happened over time. As the blue line goes down, the red line goes higher. And you can see in the most recent period, the blue line has gone down, but we haven't really moved the red line a lot, which is why folks are so focused on expecting a lot of future Federal Reserve rate hikes. And the Federal Reserve is going to look at this data, which is the gross domestic product, or GDP, for the U.S. economy. This is another government website for economic data. And you can see that GDP for the U.S. has actually been really strong over the last several quarters. And in the last couple reads was around 7%. And that's a really impressive growth for an economy as big as the U.S. economy. So the Federal Reserve is looking at strong economic growth, really good employment, and they're saying that they've accomplished half of their mandate, which is that maximum employment. Well, what about the other half? And that is why the market is so worried right now. Because if you look at the data for inflation has been really off the charts, which has been very fortunate in a lot of headlines. This is not news to you, especially if you're filling up at, getting gas or food, even at your grocery store. You're going to feel it. And you can see this inflation that's spiked here recently to upwards of 8% increase since 12 months ago. And this shows over the last 20 years. So you can see inflation has gone up and down over time. And unfortunately, here in this most recent period, inflation's really spiked. And that's what spooked the markets, is that when the Federal Reserve in that balancing act again has high inflation, they're likely going to start to raise rates and remove accommodative policy to try and tamp some of the growth. And then if we look just at the recent inflation picture, what's been driving it? A lot of it has been energy prices. Again, we all see that at the pump because of the war in Ukraine and the administration not being very energy policy friendly. And so energy prices have gone up a lot, but also prices across food, other items, other major categories. We could click in to see what they are if you wanted to. But in general, my point is that inflation is there and we're definitely feeling it. And then back to Fred, you can see that oil prices, again, this spike in oil prices is a clear indication of inflation, but also potential shocks that are going on within the oil supply and demand equation. So increasing demand, but right now supply is being cut because of the war in Ukraine, and again because of drilling policies of the administration. So you can see the fluctuating price over time, and we did have a period of time where these spikes in oil prices can cause a recession. And again, that's what is making folks get worried. And then the last bit is this is the Federal Reserve balance sheet. So as I mentioned before, one of their tools is buying bonds and selling bonds. You can see here, over the course of the last 20 years, they've really increased the amount of bonds that they've bought, and that was to try and help the economy grow. And we went through a period where they were reducing or selling bonds, but then because of COVID, they ended up buying a lot more. And now we're at a time where we've never seen the Federal Reserve have a balance sheet as big as it's had. And that's why this talk around reducing the Federal Reserve's balance sheet is scaring investors so much. And then you can see that this last chart is a really neat one because it compares the 10-year Treasury yield versus the 2-year, and it takes 10-year minus 2-year. And what that shows is what a lot of people look at is a yield curve inversion. And it sounds complicated, but what it means is that if people expect rates in the short term to be high, but in the long term to be low, that means that people are expecting a recession over the medium term, where again they think the Federal Reserve over the long term is going to have to reduce rates, and that's why that 10-year could actually end up being lower than the 2-year. And so it's usually a barometer of whether people are expecting a recession, and you can see over time it has touched this zero mark or gone negative. It doesn't happen often, but when it does, you can see these gray lines tend to follow. And that's what people are worried about now, is that we've now touched this bottom line. So is it possible that we're going into a recession? And it's uncertainty. Unfortunately, with this, you can also see that it's predicted, a running joke is that this inversion has predicted 15 of the last 10 recessions. So saying it's predicted more recessions than we've had. So we'll see what ultimately happens, but that is why investors are so worried. So what does that all show me? It's that the Federal Reserve is crushing it on the first side of their dual mandate with respect to employment. The employment picture for the U.S. looks really good, and we have great economic growth. But on the other side, the inflation side or price stability side, they're behind the curve. And Federal Reserve Chair Jay Powell talks about that all the time. And in their defense, they've had a lot thrown at them over the last couple of years. So with COVID messing up supply chains for food to semiconductors to now a war in Ukraine that's impacting oil prices, and we're seeing a spike in price just as we were starting to see an increase in demand. So what does that mean for the market? Who knows? It is so difficult to predict and very, very complex that your guess is as good as mine. And the Federal Reserve, with all their insight, they can't really get it right all the time either. So does that mean we're going into a recession? It's very possible. We definitely could be. But in my opinion, over the last several years, Federal Reserve Chair Jay Powell has proven that he can operate very well in some very challenging environments. Just look at COVID, and the economy was doing really well as we came out of that. So in my opinion, when I see him present about the economy, it gives me a lot of confidence that the U.S. is in good hands. And I believe the Federal Reserve can stick the soft landing, which means that they can remove accommodation while not crushing the U.S. economic growth picture. But most importantly, the Federal Reserve is committed to staying data dependent. So that means if the economic data changes and starts to show some weakness, the Federal Reserve can then change their monetary policy and maybe be a little bit more accommodative. It's important to remember that all of those considerations about the Federal Reserve and recession, that's at the macro level for individual companies. And while the macro matters for those stocks, it's also really difficult to predict. And it goes to another takeaway that I've talked about before, which is that you can't time the market. But overall, for me at the macro level, I believe in the US economy. You can call me patriotic, but I believe that over decades, the US will continue to grow because of hardworking people chasing the American dream, but also really amazing innovation that's powered the world's growth for years. And that's happened in the past, and I think it can continue to happen in the future. And as Warren Buffett has recently said in annual letters, you do not bet against America. And I'm heeding that advice, and my bet is on America. So for individual companies with a macro that's so difficult to predict, what do? Well, that leads me to another Thomas takeaway, and I don't know the number, but it's that in tough markets, I really try and focus on finding high quality companies. And then when times are good, the number one thing I look for is a quality company. And that's my strategy. I want to find really great companies that have bright futures, can stay in front of competition, and management teams that are going to make a lot of money for shareholders along the way. And then voila, I don't have to sweat the macro, and it's liberating. Are the companies that I own going to feel pain in a bad macro environment? Absolutely. Yeah, 100% they will. But I also believe that you can't time the market. So for me, the number one priority is finding a good company that can succeed no matter what is going on in the economy. And if you have a company with a bright future that can stay ahead of competition in good times, that company is going to beat the competition and take advantage of an awesome opportunity that's out there, say like Tesla. But in the bad times, I trust that that company is going to be able to take market share from weaker competitors. It's going to emerge stronger and hopefully even have a little bit of growth, even in a recessionary and tough economic environment, just like Amazon's done for so many years. You throw in a capable and focused management team to manage the company through the thick and thin, and that sounds like a winning recipe to me. You throw in a little time, time, and that's how you too can participate in awesome wealth creation that happens with amazing businesses. And that is what we're trying to do here. If you got any value out of the video, I would really appreciate a like or subscribe to the channel. It always helps grow the community. Thank you so much for tuning in, and I'll see you next time.